I wish that real estate investors would focus less on gentrifying areas.
Cheap is cheap for a reason. That's how every real estate market, probably in the world, works. What is something you wish more real estate investors understood about Indiana? Because you're somebody, you work, obviously we've been talking about, you work on the leasing and property management side, but you're also a licensed broker. You've helped people buy and sell properties with our team as well.
I think that's a great question. I think my answer to that would be that Indiana is steadily growing, which means that every part of Indiana is going to continue to appreciate. And so in that flip side, I wish that real estate investors would focus less on the gentrifying areas, because if you look at it, and when I say that, I mean areas that are going to be more difficult to lease, more difficult to retain tenants, and with that in mind, you know, they're looking at gentrified area or gentrifying areas and hoping that they can get a better deal, or you know, like a duplex for a cheaper amount, and hoping that it's going to appreciate more, which it may, than your typical suburban area or a more stable location. But you're going to pay for that gentrification over time, right? Because at that point in time when you buy a place, you may get it for a cheaper amount, but you're also facing higher turnovers. You're facing higher vacancies. So I often see real estate investors that are stuck on their spreadsheet, right? And they're not acknowledging the things that you can't put on a spreadsheet, the damage that is going to happen to your unit time and time again.
Yeah.
So I say this because I feel like oftentimes, if just seeing it and being in it so long, I would say that wait a little bit longer to be able to buy in a little bit better of a place than automatically jump in, because that's my personal opinion, because I feel like in being in property management for so long, you get into a duplex that does not perform and you end up not making any money. You end up losing money over the course of 2 years. And then finally that's happened over and over and over again. And then, well, I'm just going to sell. And it's hard to sell. So, and I feel like I'm dealing with one of those situations right now where they purchased a property and it was in a crappy area, and you know, they're not going to make. So long story short, if you're asking about, you know, why or what real estate investors want to know about Indiana, I'd say just pinpoint better places, less.
Yeah.
You know what I'm saying?
It's considered more than just cash flow.
Right.
And the way I usually frame it for investors, and I'll use kind of the Indianapolis investor map that we created a few years back as kind of a reference point for, you know, you can invest in C class and D class areas. That is always on paper. That's where the cash flow is going to look the best, because that's where the rent is relatively higher. And that's where the purchase price is relatively lower. So, but you know, we can always say like cheap is cheap for a reason. And that's not just, you know, that's not only how Indianapolis works. That's how every real estate market probably in the world works, you know. Definitely in the United States, it's how it tends to go, is your A class and B class areas. If you buy a property in those areas, you're not going to be cash flow positive. Like your rents don't keep up with what the purchase price is, because everybody's kind of competing for those properties. But now you just bought a property that has the closest thing you can have to guaranteed appreciation. But buying in sort of a C class or a D class, the hope is gentrification. The hope is like all of a sudden, you know, this area is going to start growing. And the whole time you've been cash flow positive on it, which I think there's something to be said for that. But that's why I always where I buy rental properties, and you know, I've always been kind of like, I can help an investor buy a property with A class, B class, C class, D class, whatever you want, but I just want you to understand what you're buying. If if you're buying in D class, like we're going to have trouble finding a qualified applicant here, even though the numbers look good on paper. Like I would say D class stands for drama. It just means that you're going to be dealing with evictions. Like, your tenant might end up in jail. Like, you just don't know what's going to happen. But I mean, on paper, that rent rate to price ratio looks great. It's like, well, that's not all you're experiencing. Like, you're experiencing, a lot more costs that aren't accounted for. Not to mention what you paid for that property. Let's say you paid $100,000 for it. I mean, that's also the value kind of after you buy the property. On that property, if you have to replace a roof for $10,000, that's a tenth of your value that you have to now spend on this property, versus if you buy a $400,000 property in an A class, that roof also costs $10,000, but now it's a 40th of the value. So it's like that ratio of CapEx and maintenance cost is way higher when you're working with cheap properties.
I mean, I guess if I'm just looking for my ideal investment would be, and I feel like these are the most stable, are your 3-bed, 1-bath, 3-bed, 2-bath, single family homes in a good school district. And I think the big thing on the school district thing is where you're going to have less vacancy. You're going to have less turnover, because these are your traditional families that are moving in with kids that, are in that school district, and they're going to stay there for 2, 3, 4 years. That's something to think about. And I have some clients that operate strictly on that. And I feel like they do pretty well. I mean, and they may not have as much cash flow, but on the flip side, one thing that you can do to counter that out is find minorly distressed properties in these areas with these classifications, gain your sweat equity in the beginning, and then rent them out for, and the perfect pocket in rentals is like your $1,400 to $1,800 a month. That's where you're getting your good tenants. That's where your tenants that it's not incredibly hard to lease out. We have plenty of properties that are every bit of $2,000 to $2,800 a month, but it's a certain type of demographic that is willing to pay that much for rent per month. So I've found that the sweet spot is your single family, 3-bed, 2-bath in a good school district. They rent out like that, and they often, once you get a good tenant in there, they rarely leave. Yeah. And those are all the boxes that you want to check with a good investment property, I think.
You're saying something similar to something I've kind of started to really think as I've just worked with a lot of investors over the years, is there's nothing easier to lease than median. And there's also nothing easier to sell than median. Right. So like our median purchase price in the greater Indy area is $250,000. That's going to be the easiest home to sell on the market. Same goes for rent. If I don't know exactly what it is right now, but it's probably around $1,500, $1,600. If our median rent is that, properties typically, like maybe you're talking like a 3.2, 3.1.5 in a B or B minus kind of area. Yep. That property is the easiest property to lease.
It rents itself out.
Yeah, there's the maximum number of tenants that want that. But yeah, as you enter the two ends of that spectrum, if you go down to your $600, $700, $800 a month efficiency rental in a C class, that can be hard to lease. We'll probably get tons of applications, but finding somebody qualified to move in there is a challenge with those smaller units. It's doable, but it's more of a challenge. Same with your higher end, like your $2,500, $3,000 a month. Like there's a tenant for that, but it's probably going to take us a little bit longer to find it.
Yeah.
Yeah.
And everything that comes after the deal is always going to be more expensive on a $100,000 single family home, like inefficient windows, poor insulation, knob and tube that's probably going to have to come out and be fully replaced.
Deferred maintenance.
Yeah.
That's deferred maintenance is like it's the enemy of the rookie investor.
Something that you don't really you hope doesn't happen, and when it does, it's a lot more expensive than you thought it would be.
You can check out our full library of episodes wherever you get your podcasts.